Stocks versus bonds. Investors are often told to diversify their portfolio between stocks and bonds. But what actually is the difference? Let's take a basic look at the similarities and differences between stocks and bonds. Stocks and bonds are the two most common ways for a company or entity to raise money, usually to expand future operations. In simple terms, stocks are shares of companies. When a company issues a share, they're selling a piece of themselves in exchange for money, which is believed to help the company grow in the future. Bonds, on the other hand, represent debt. Bonds are issued by companies, as well as governments and municipalities. When one of these entities issues a bond, it is issuing a debt with the agreement to pay interest to you for the use of the money now. Let's take a deeper look, starting off with stocks. So, we know stocks act as a piece of ownership of companies, but where and how are they actually sold? Well, they're sold off on exchanges, usually in exchange for cash. When private companies want access to more money, they may decide to go public. This way, they can sell pieces of their company with shares or stock in exchange for money in what is called an initial public offering, aka an IPO. Without going into too much detail about the IPO process, a company planning an IPO will usually select an underwriter to value their stock or company value and choose an exchange where the shares of stock will be issued and traded. Stock is bought and traded to retail investors on public exchanges like the New York Stock Exchange or NASDAQ. Typically, stock is traded through a brokerage firm like Fidelity or E-Trade and has small fees every time you make a trade. Prior to an IPO, a company is considered private. As a private company, the business has grown with a relatively small number of shareholders, including early investors, like the founders, family, and friends, along with professional investors, such as venture capitalists or angel investors. When a company reaches a stage in its growth process where it believes it is mature enough for the rigors of SEC regulations, along with the benefits and responsibilities to public shareholders, it will begin to advertise its interest in going public. Typically, this stage of growth will occur when a company has reached a private valuation of approximately $1 billion, also known as unicorn status. However, private companies at various valuations, with strong fundamentals and proven profitability potential, can also qualify for an IPO, depending on the market competition and their ability to meet listing requirements. After an IPO, investors can buy or sell additional shares in the open market. When a stock is bought, usually through a brokerage, investors then have a part stake in the company and will be able to sell or trade their stock to other investors to make profits or take losses. Stock prices can be extremely volatile, especially when they are first issued, as a stock price does not generally have to do with how well a company is actually doing, but rather with the public perception of how a company is doing or will be doing. For example, on June 8th, Nikola Motors had a higher value than Ford Motor Companies, and Nikola does not plan to make a profit until 2023, and does not even have any cars on the road, while Ford make a net profit of $155 billion in 2019. Stocks have two main ways to create a return to investors. An investor can make money through either nominal returns and through dividends, or hopefully both. Stocks often operate off of nominal returns, which express net profits or losses on an investment. For example, if you bought a stock at $100 per share and sold it at $120 per share, you would get a nominal return of $20. Companies can pay out profits to investors through dividend checks, typically paid quarterly. However, not all profitable companies pay dividends. Dividends are a way for companies to split some profits with shareholders. There are two main types of stocks, common and preferred. Both common stocks and preferred stocks can be worthwhile investments, and you can find both types of stock on major exchanges. There are many differences between common and preferred stock though, and depending on your needs, one type of stock may be a more suitable choice for you than the other. Even though its name might suggest that preferred stock is a better investment, most investors focus on common stock because of its uncapped potential. Common stock gives investors partial ownership in a company. Many companies exclusively issue common stock to investors, and there's a lot more common stock available on stock exchanges than preferred stock. Investors holding common stock typically have the legal right to vote to name representatives on the company's board of directors and to approve major corporate decisions, such as mergers. Common shareholders have the right to receive any dividends that the company declares on their shares. However, common stock is more risky than preferred because preferred stockholders have the right to receive their dividends first, and dividends are not guaranteed for common stockholders. The most attractive feature of common stock for investors is that its value can rise dramatically over time. As a company becomes more successful, its common stock price typically goes up. The most lucrative common stocks have seen their prices multiply 100-fold or more over the course of a company's history. Apple's stock is a famous example of how much an investor can make by investing in common stock. In 1980, Apple IPO'd at a price of $22 per share. Today it's worth around $380 a share. Accounting for 4 stock splits in its lifetime, if you invested in Apple at its IPO in 1980, today you would have a 51,000% gain. That is 510 times your money. Some companies choose to issue preferred stock in addition to common. Preferred stock typically has a set dollar amount that the company can pay shareholders back to redeem these shares. Most preferred stock pays dividends, and the amount tends to be higher than what common shareholders receive. Preferred stock usually pays fixed dividends year in and year out, rather than seeing changes in payout amounts from quarter to quarter, as common stock dividends are. The label preferred comes from 2 advantages that preferred stock has over common stock. 1. A company must pay out dividends to preferred shareholders before common shareholders receive any dividends. 2. If a company fails and its assets get distributed to investors, preferred shareholders must receive a fixed amount of money before common shareholders can get any of their investment back. This is also true in the case of bankruptcy, where preferred shareholders will receive any payment first, while common shareholders have a higher risk of losing it all. Those attributes make preferred stock especially attractive for investors whose primary focus is on income. Most preferred stock won't see large price increases, even if the company that issued it is successful. However, predictable dividends that have priority over common stock dividends give preferred shareholders more confidence that the company will pay out the income they need. Keep in mind the one major disadvantage to preferred stock. Preferred shareholders often don't get any vote on corporate matters. There's no limit to the number of different preferred stock classes a company can issue. It's not unusual for a company to define multiple preferred share classes, featuring different dividend rates and dates at which the company can redeem the stock by paying investors their capital back. Companies can also issue convertible preferred stock. In addition to having the normal attributes of preferred stock, convertible preferred gives the shareholder the right to take their preferred shares and convert them into regular common stock under certain circumstances. The conversion right gives convertible preferred stock more upside potential than regular preferred stock, making it an attractive option for some investors who like the combination of higher dividend income and possible share price increases over time. Now, let's take a look at bonds. While stocks are a stake of ownership in a company, a bond is a debt that the company or entity enters into with the investor that pays the investor interest on that debt. Essentially, bonds are IOUs that companies enter into with investors on the pretense that they will repay the money lent in full with regular interest payments. However, bonds can be issued by a company, a city, or a government, in the case of government bonds, and are generally considered a lower risk option compared to stocks. Bonds are created when a company, government, or other entity wishes to raise money to finance a project, growth, or development, and wishes to use investors instead of a bank to create loans. Bonds are fixed income investments, which operate off of a fixed interest rate and a fixed amount of time, wherein the company, government, or other will repay the money plus the interest. The interest rate is called a coupon rate, to the creditor, at the point of maturity. For this reason, bonds are frequently called fixed income securities, which, as the name suggests, may be more dependable than investing in stocks. For example, if you have a fixed-rate coupon bond, which pays the same interest rate over time, at 5% at $10,000 par value, you would receive an annual $500 in interest as the bondholder. And even if interest rates across the board drop a percentage or two, the bond coupon will rest at 5%. The different types of bonds populate a financial spectrum, from big business to small municipalities. Government, corporate, and asset-backed securities are the primary bond types. Bonds issued by the federal government are called sovereign debt, which is funded by the country's printing of currency or taxing its citizens. Government bonds are further broken down into classes, according to when they mature. Government bills mature in less than a year, notes mature between 1 and 10 years, and bonds mature in more than 10 years. Some bonds have maturity dates that stretch 20-plus years from their purchase date. Not surprisingly, these bonds pay investors a higher interest rate for their long-term investment commitment. Another type of government bond is the municipal bond, also called munis or city bonds. If the government entity is a city, these bonds may be issued by government agencies, as well as state and local governments. The investing risk is typically higher for munis than federal government bonds. For example, a city can go bankrupt and default on its bond payments. Corporations represent a large sector of the bond market. They have a wide range of flexibility in issuing debt securities, typically depending on market pressure. One downside to investing in corporate bonds is a higher risk for investors compared to government bonds. But a perk for the higher investing risk typically is a higher yield on the investment. When corporations issue bonds, their length to maturity divides them into 3 classes. Short-term corporate bonds mature in less than 5 years, intermediate corporate bonds mature in 5 to 12 years, and long-term corporate bonds mature in more than 12 years. Corporations may issue convertible bonds, which offer their bondholders the option to convert their bonds at a certain date to shares of common stock. Corporations may also issue callable bonds, which offer their bondholders the option to redeem their bonds before their actual maturity date. Also known as ABS, asset-backed securities represent bonds that are created from the collective cash flow package of a similar pool of assets. For example, a bond may be composed of a pool of mortgage loans, called mortgage-backed securities, also called MBS. While bonds may be traded through exchanges, as corporate or government bonds often are, they are commonly traded over the counter, which means that investors engage in one-off deals with each other or through informal networks of bond dealers. Let's take a look at the pros and cons of stocks. The biggest pro of investing in stocks over bonds is that history shows stocks tend to earn more than bonds, especially long-term. Additionally, stocks can offer better returns if the company growth is exponential, earning the investor potentially millions on an originally minuscule investment. For investors willing to take the risk, stocks can pay more than bonds in returns, as the company's stock could continue rising. Still, stocks are not always the best option. As a con, stocks make no promise of future returns on initial investments. Because the stock market is unpredictable, it is very easy to lose money by investing in the wrong stocks. For this reason, stocks are often considered higher risk than bonds. Now for the pros and cons of bonds. In contrast with stocks, as a pro, bonds are often lower risk due to how they have fixed coupon or interest rates on their loans. Additionally, fixed-rate bonds can be resilient to changes in interest rate fluctuations in the economy, making them a desirable asset to own in uncertain times. However, as a con, bonds don't have as much income potential as stocks, the latter of which can multiply in value overnight, conceivably. Still, according to Time Money 101, since 1928, stocks in general have earned around 10% each year, compared to bonds 5% to 6%. Thank you for watching, and I hope you have a better understanding of stocks and bonds. Make sure to write in the comments section any tips you may have for others.